4 days. We have exactly 4 days left before one of the most severe structural fractures in the history of the precious metals market officially detonates. Forget the mainstream financial media narrative. This is a countdown driven by raw mathematics, and the math does not lie. The COMEX March silver futures contract hits first notice day on February 27th. They are staring down the barrel of a physical delivery wave, totaling 429 million ounces. But do you know how much deliverable metal is actually sitting in their registered vaults right now? Just 89 million ounces. That is a mathematical impossibility. Silver just closed the Friday session at roughly $87.73 per troy ounce. That is a 25% surge year to date. But I have to be completely straight with you. That $87 price tag is nothing but a paper illusion. If you took $87 and walked into a bullion dealer right now trying to buy a physical ounce of silver, they would laugh you out of the room. The disconnect between the paper illusion and physical reality has blown out to a staggering 54% physical premium. This liquidity bomb is ticking down by the hour. From the geopolitical resource war raging in the East to the leveraged delusions collapsing in the West, everything is converging right now. And this is exactly what you need to know to protect your wealth before next Tuesday. We are going to break down the COMEX delivery crisis, the Supreme Court ruling that just struck down the presidential tariffs, and the immediate pivot to stockpile strategic minerals. We will cover China locking down global refining supply and India absorbing a quarter of the world's metal. I will also give you the honest bear case because intellectual honesty is the only way you survive this market. Let us begin. Let me take you back to the exact setup that triggered this crisis. You cannot understand the 4-day countdown we are facing right now without fully grasping the absolute bloodbath that occurred in the markets this past January. Because what silver just did in the last 4 weeks has absolutely zero precedent in the history of modern commodity markets. Silver opened the year 2026 near $70 per ounce. Through the month of January, it went completely parabolic. The rally was relentless. It was structurally driven by massive physical demand, speculative momentum in the futures market, and a massive gold breakout pulling silver along for the ride. On January 29th, silver touched an astonishing $121.67 per troy ounce. Let that sink in. $121. That action completely obliterated the historic 1980 Hunt Brothers record of $49.45 that had stood as an impenetrable ceiling for 45 years. What happened next was equally historic, but in the violent opposite direction. Within approximately 30 hours, silver collapsed 47%. It plummeted from $121 down to roughly $64. The exchange panicked and aggressively hiked margin requirements to 15% to force traders out of their positions. The Treasury Secretary immediately attributed the forced liquidation to speculative activity from foreign traders. It was a coordinated narrative to explain away a deliberate engineered crash designed to save the financial institutions trapped on the wrong side of the trade. The sell-off continued into early February, bottoming at $63.85 on February 6th. A second sharp decline on February 12th and 13th saw another 10% single-day drop. It was the third worst daily decline in 6 years. But here is the critical detail that the mainstream financial crash narrative misses entirely. Every single one of those violent paper sell-offs was met with a massive wall of aggressive physical buying. The recovery from $63.85 to this week's close of $87.73 represents a 37% bounce in just 17 days. That is a V-shaped recovery in a heavy physical commodity market. It defies all traditional technical analysis, and the technical indicators now flash strong buy signals across multiple timeframes. The critical resistance at $84.91, which was a long-term downward trend line, broke cleanly on February 23rd. The next major target sits at $92, then $100, with the all-time high of $121.67 looming right above it. And here is the specific detail that should make every single short seller sweat. Managed money net long positions currently stand at just 5,472 contracts. That is a tiny fraction of the level seen during the massive January rally. The speculative community, the leveraged paper traders, have not even re-entered this trade yet. The entire violent move from $64 back up to $88 has been driven almost entirely by pure physical demand and terrified short covering. The leverage longs have not even shown up to the party yet. That is the fundamental context you need. Now let me show you exactly why the next 4 days could go down as the most important in silver market history. This is the section that the financial media will not cover because they either do not understand the mechanics or they understand them perfectly well and are terrified to explain them to the public. The COMEX exchange, which is the primary exchange for precious metals futures in the United States, operates on a trust-based system where contracts can either be settled in cash or settled by the actual physical delivery of the metal. Most of the time, the vast majority of contracts are simply rolled over to the next month or settled in fiat cash. Actual physical delivery is the rare exception. Except right now, physical delivery is no longer the exception. It is rapidly becoming the absolute rule. COMEX registered silver, which is the specific metal that is actively earmarked and legally available for futures delivery, fell to 88.79 million ounces as of February 19th. That critical drop happened after a massive single-day withdrawal of 3.36 million ounces. Let me put that terrifying number into proper historical context. This registered inventory has collapsed over 80% from its 2021 peak. It dropped 38% just since October 2025 when it stood at 167.7 million ounces. In January 2026 alone, 33.45 million ounces were physically withdrawn from the vaults in just 7 days. That is roughly 26% of the entire registered inventory disappearing into private hands in a single week. January deliveries totaled 49.4 million ounces. That is more than 7 times the delivery volume of January 2024. The February delivery rate hit an extraordinary 98%. That means nearly every single contract that could legally demand delivery actually demanded the physical metal. Now we stare down the barrel of the March 2026 delivery month. The first notice day is February 27th. That is exactly 4 days from now. Open interest on the March contract currently stands at 429 million ounces, against roughly 89 million ounces of registered silver. Read that math again. 429 million ounces of contractual paper demand. 89 million ounces of actual deliverable physical supply. If even 25% of those paper contracts stand their ground and demand physical delivery, the exchange would immediately need 107 million ounces. That mathematically exceeds the total registered inventory in existence, and the futures are already trading in severe backwardation. That means the spot price today is higher than the futures price tomorrow. That is an incredibly rare condition in precious metals, and it screams like a siren that buyers are willing to pay a massive premium to secure physical metal right now, rather than accept a hollow promise for delivery in the future. The total exchange silver vault, including registered plus eligible, sits at roughly 369 million ounces, but only 24% of that qualifies as deliverable. The rest is eligible inventory, which means it is physically stored in the vaults, but it legally belongs to specific private owners who have absolutely not made it available for delivery to bail out naked short sellers. You cannot force eligible metal into the delivery process. It is not your metal to sell. The incredibly uncomfortable question that this brutal math raises is straightforward. What happens if the contracts that stand for delivery mathematically exceed the physical metal available to give them? In prior historical episodes, the resolution has typically involved one of the major bullion banks stepping out of the shadows to provide emergency delivery notices or forcing massive cash settlements behind closed doors. They bribe people to walk away. But each time that happens, it strains the credibility of the entire system a little bit further. And the short sellers who are trapped on the wrong side of these massive contracts face an impossible choice. Deliver metal you do not have, or buy it on the open market at whatever exorbitant price the longs demand. This is not a wild theory. This is public data. The Mercantile Exchange publishes these exact numbers every single day. Anyone can verify this for themselves. The people who check primary sources understand exactly why February 27th is not just another random date on the financial calendar. When the futures crashed 47% in January, the physical silver premium surged to 54%. Dealers effectively refused to sell at the fake paper price. If the spot price on the television screen said $64, the actual cost to acquire a physical ounce of silver was closer to $98 to $100. That is a 54% disconnect between what a futures contract says silver is worth and what it actually costs to hold the metal in your hand. American Silver Eagles are currently trading at approximately $102.74 at major online dealers. That is a $15 to $20 premium over the $87 spot price. Canadian Maple Leafs and Britannias show 7 to 10 day fulfillment delays versus normal immediate shipping. Major bullion dealers reported wholesale offer sheets showing completely sold out across most major products. The Royal Canadian Mint saw their lease rates spike from 1 or 2% up to over 100%, forcing some mints to halt production entirely. Several United States refineries completely stopped purchasing scrap silver because processing became unprofitable at those lease rates. Silver lease rates in London surged from a normal 0.3 to 0.5% up to over 8% annualized. The exchange for physical spread, which is normally about 25 cents per ounce, expanded past $1.10. And the London Vault holdings total approximately 27,700 tons, but roughly 75% of that is locked tight in exchange-traded fund allocations. The actual free float available to the market is perhaps only 200 million ounces. For context, on October 10, 2025, the London silver market completely seized up for 1.5 hours due to absolute liquidity exhaustion. The plumbing of the physical silver market is under more stress right now than at any point in modern history. This is exactly what happens when a market runs a structural deficit for 6 consecutive years. While industrial demand accelerates and the paper price becomes an absolute fiction, physical reality demands a completely different number. The largest silver exchange-traded fund closed at $76.62 on February 20th, up 7.9% on the day. The market cap is $42.52 billion, with total holdings exceeding 510 million ounces. On January 27th, the trading volume for this single trust hit an all-time record of $38.2 billion. That nearly matched the most traded equity fund in the world. Call option bets on the trust reached approximately $40 billion. That is equivalent to roughly half the world's annual silver production. The speculative interest in silver through the exchange-traded fund channel alone is enormous. Now look at the mining stocks. This is where the real disconnect exists, and where the informed minority is paying very close attention. First Majestic Silver closed at $25.42. They reported record production of 15.4 million ounces in 2025, up 84% year over year. The stock is up 303% in a year. Pan American Silver beat their fourth quarter earnings on revenue of $1.18 billion. Hecla Mining reported record third quarter revenue of $410 million, up 67% year over year, with silver all-in sustaining costs of just $11 per ounce. Let me repeat that, $11 per ounce to mine the metal. Silver is trading at $87. The profit margin on that is extraordinary. And yet Wall Street analyst price targets for these companies are still modeled as if silver trades at $25 to $50. The street has simply not caught up. The models have not been updated. Which means these mining stocks, despite their massive runs, may still be dramatically undervalued relative to the current and forward-looking silver price. If you ask most financial advisors about silver mining exposure, they will look at you blankly. It is not in their playbook. It is not in their model portfolios. It is not on their radar. And by the time it is, the massive asymmetric move will be completely mature. Let us shift our focus to the geopolitical landscape because the paper trading community absolutely refuses to discuss how global powers are cornering the physical market. On February 20th, the Supreme Court ruled that the sweeping presidential tariffs were unconstitutional. Within hours, the administration pivoted and imposed a new 15% across-the-board tariff under a different legal authority. But here is what matters for precious metals. Silver and gold imports remain completely exempt. They are classified under critical minerals and bullion codes that were specifically carved out of the tariff structure. This means physical silver flowing into the United States from major producers will not face additional costs. More importantly, the administration separately launched Project Vault. This is a $12 billion initiative to build a massive critical mineral stockpile. Silver is on that exact list. The United States government is actively signaling that it views silver as a strategic material worth hoarding. When the largest economy in the world starts treating silver like a strategic asset at the exact same time that the largest refiner in the world locks down its borders, you are watching a fundamental repricing of reality. On January 1, 2026, China officially reclassified silver as a strategic material and implemented strict export licensing requirements. They effectively prohibited silver exports unless the exporter is explicitly government-approved. Only 44 companies received approval, and they must demonstrate massive production capacity. Why does this matter globally? Because China controls up to 70% of the world's silver refining capacity. When China restricts exports from those facilities, it structurally removes the absolute majority of global refined output from the international market. The Shanghai Premium tells the entire story. Wholesale physical silver in China recently commanded a 45.8% premium over the Western exchange. That kind of massive price dislocation only exists when supply is being deliberately choked off while demand accelerates. China is telling the world that their domestic solar panel and electric vehicle manufacturing needs come first. While China restricts the supply, India is eagerly absorbing whatever is left. In 2025, India imported nearly 6,000 metric tons of silver. That is approximately 190 million ounces. A single country absorbed 25% of the total global silver supply. Indian Silver Exchange Traded Fund inflows nearly tripled the prior year. This is driven heavily by government incentives, targeting 500 gigawatts of renewable energy by 2030. The structural trajectory is undeniable. We are in the sixth consecutive year of a global structural deficit. The cumulative deficit from 2021 through 2025 totals 820 million ounces of metal that has been consumed and is completely gone. But let me give you the absolute honest bear case against the immediate bull thesis. Because intellectual honesty is what separates education from pure hype. First, lighter liquidity environments amplify violent moves in both directions. If silver gaps up on thin trading, it can reverse and crash just as fast. Light liquidity is not confirmation, it is a condition that demands maximum caution. Second, the delivery anomaly, while mathematically unprecedented, has produced managed resolutions before. The major bullion banks have navigated these exact situations using emergency cash settlements and position rollovers. Dismissing the possibility that they manipulate their way out of this one would be dangerously naive. The system is under massive stress, but it still has powerful shock absorbers. Third, silver is heavily reliant on industrial demand. Over 50% of its consumption is tied to electronics, solar panels, and vehicles. A genuine global recession would trigger massive demand destruction. That would temporarily overwhelm the entire supply deficit narrative and crash the price. These are very real risks that you must weigh alongside the bullish structural case. Anyone who tells you silver can only go straight up from here is lying to you. The calendar this week is stacked with potential economic catalysts, from consumer confidence and durable goods orders to major technology earnings, acting as a proxy for artificial intelligence demand. A hot inflation print complicates the interest rate path, but metals are currently rallying on both hot and cold inflation because the underlying fiat currency system is fundamentally breaking down. The dollar share of global reserves is at a 32-year low, while the national debt crosses $38 trillion. The trend of moving away from the dollar is not a future event. It is happening right now in real time. Taken together, the silver market structure in late February 2026 is unlike anything we have witnessed in modern financial history. The underlying physical fundamentals have only tightened during the recent extreme paper volatility. The exchange-registered inventory sitting at just 89 million ounces, while the March delivery open interest looms at 429 million ounces, creates a mathematical mismatch that absolutely must resolve one way or another by February 27th. China implementing export restrictions has structurally removed the majority of global refined supply from the open market. India is simultaneously absorbing a full quarter of the remaining production. The monetary regime shift is no longer a theoretical debate. Central bank precious metal holdings are exceeding foreign treasuries. The dollar share of global reserves is sitting at a 32-year low. Emerging nations are actively building alternative settlement infrastructure. And the United States national debt has breached $38 trillion. These are not future risks to prepare for. These are current structural conditions. And they are the exact conditions that historically produce the kind of violent precious metals repricing we are observing in real time. The exchange delivery data is entirely public. The positioning reports are public. The Shanghai premium is public. The ones who take the time to verify primary sources understand exactly why what is happening right now is not market noise. It is a blaring structural signal. This is financial warfare education. It is not financial advice or a trading signal. You must verify everything I have shown you today. Check the primary sources. Do the math yourself. If you found this raw data analysis valuable and you want to stay ahead of this historic wealth transfer, drop a comment below and let me know your thoughts on the March delivery deadline. Subscribe to ensure you do not miss the next breakdown where we will cover the digital settlement system the emerging nations just launched to bypass the dollar. Invest with cold logic and never with emotional hype. I will see you on the next one.